Hello and welcome to Rajya Sabha Television. You're watching a brand new edition of Policy Watch with me, Rausan Pereira. The Reserve Bank, for the second time in 2 months on Wednesday, raised its benchmark interest rate by 25 basis points on inflationary concerns, a move that will make home, auto and other loans expensive. With 5 of its members voting for the increase, the 6-member Monetary Policy Committee, headed by RBI Governor Urjit Patel, increased repo rate at which it lends to other banks to 6.5% but kept its policy stance as neutral. The reverse repo rate at which it borrows from banks was also raised by similar proportion to 6.25%. The marginal standing facility rate and the bank rate were also raised to 6.75%. RBI had last raised the repo rate on June 6th by 0.25% to 6.25%. That increase was the first since January 28, 2014, when rates were hiked by a similar proportion to 8%. In the subsequent years, RBI cut interest rate on 6 occasions. In our first segment of Policy Watch today, we will take a closer look at the RBI's monetary policy. Joining me on the program today are Subhomoy, Bhattacharjee, consulting editor of the Business Standard, and Ajay, former Secretary, Ministry of Commerce and Industry. Thank you to both my guests for joining me on this edition of Policy Watch. Mr. Dua, let me begin with you first, of course, and ask you, why has the RBI gone for a second consecutive rate hike?
As the RBI governor mentioned in his press conference, the inflation had crept up, though it may be the June figures were 4.7 and now it was 4.8, just about 10 basis points. Apart from the fact that there is a likelihood of their increasing further, and those factors were spelt out by him. One could be the continuous pressure because of the crude price. Second, he talked about the global uncertainty coming out of the trade wars, and he even elaborated that these trade wars could spill into or become currency wars, in which case the stability issue comes in. And third, he talked about that the higher procurement price for agriculture price, the MSP, minimum support price, which the government has recently announced, that could have an impact. He did not spell out what the possible impact could be, because real impact will be in the second round, when you give to the farmers, in turn the food price goes up, and all the way, that chain. So I would say what he's really done is, yes, there's a marginal increase in food prices, a marginal increase in prices above the 4%, which is what they've been taking as their mandate. And this is for the 8th month in a row it's been above 4%. And then again a marginal increase, largely coming from not so much the food sector this time, but much more. It was from fuel and lighting. Second, from clothing, and third was from a certain manufactured products.
Right.
I would say, while the things are not so bad, he's also probably taken a preemptive move.
Right.
That because there's so many uncertain factors remaining, which he talked about, to beat the uncertainty, remain ahead of the curve. And at this point of time, when the food prices usually in the summer months go up.
Yeah.
This time they haven't gone up so much. If anything, the food inflation is a little less, and the monsoon has been good, and the area sown probably is just a couple of % less than the previous years. By all accounts, the agriculture output should be good.
Right.
So he felt that this is a good time going forward, when things are not so bad, but there is definitely uncertainty for the future. Why not strike now?
All right. Subhomoy, the reasons given by the RBI governor for this rate hike, the second consecutive one, are they justified?
Yeah, you should note that the mandate that the Finance Ministry and the RBI has signed on in the MOU, it clearly says RBI will be an inflation targeting organization. So its primary mandate is to ensure that inflation does not go out of hand. Growth, yes, but growth is not RBI's primary concern. It looks at growth as an addendum to the entire universe, but its primary mandate that's been clearly defined. Now, one can argue with that is inflation. So if inflation figures start wobbling, then RBI would move. So by going by that mandate, RBI was straight on. It says, I don't like the look of the inflation. I am supposed to deliver an inflation of 4%. This one is looking that it's actually going to be 5%, and it stayed for 5% for quite some time. So I'm going to take measures to ensure it doesn't go beyond further towards 6, and I'll pull it down towards 4. And that is exactly what RBI has delivered on. In fact, if you look at the trend of this monetary policy committee, it has tended to move whenever inflation has tended to become stiff. And with the core inflation, which is basically the inflation beyond the usual stuff, seasonal factors like food, fuel and all those things, since that inflation has hardened, and it's also saying that inflation will be about 5% in fact, for the first time it's given a forward projection for the next fiscal, which is FY19. That will be something like 5%. It has got very good reason to say that I would be moving up my armed weapons to ensure that inflation does not go out of hand.
Right.
And that was the primary call that the RBI needed to take, and RBI has taken.
All right. Mr. Dua, what do you make of the neutral stance of the MPC?
I think it's been a little diplomatic, I would use the word, for the RBI governor. His actions don't really match the guidance which he's given. By all accounts, if you have two increases, one within a period of 8 weeks, by all accounts, it would be called hawkish. But he's called it neutral, probably to wrap up good packaging to the increase in actual rates, which is affected by 25 basis points, and also probably to soothe the debt market. Otherwise, the rates at which the government, these are government bonds, etc., the returns would have gone up immediately. Yesterday, people, in fact, for a while thought that when they were listening to the speech, and he hadn't as yet talked about the guidance, that it should be now about 7.95 10-year bond yield. Luckily, it remained at 7.74, 7.75, because he, by calling it neutral, acting a little differently, I won't call it in any way, three, accommodative, neutral, and hawkish. That it was by action hawkish, but called as a neutral, and that to some extent gives him a greater degree of flexibility going forward what he will do. Had he called it hawkish, then people knew that probably another rate hike could be in the offing. So depending upon all those factors which is listed as uncertain, the MPC could take a call either way, whether it's 2 months down the line or in December. And I would say, closer you go to the elections, the dangers of higher fiscal deficit become more realistic. So he's, by calling it neutral but acting in a different manner, tried to even accommodate the fact that there could be higher fiscal deficit, government populist measures of the government, and that the impact of the minimum procurement price could also be more significant than has been anticipated. So by neutral, he could continue to hike as well.
Right.
But at the same time, he didn't want to alert the markets, I would say, too much.
Okay. Looking ahead, looking at what's likely to happen in the future, Mr. Dua said it's all open now with this neutral stance. But after 2 consecutive hikes, Subhomoy, do you think that the MPC is set for a pause?
See, there's also another part to it, which is that the last time when we had a soft rate and the economy was growing, we ended up giving up massive loans from the banks, which has created our NPMS. The events of 2011-12 and 12-13 show us that in time when growth picks up, and if the banks are not willing to do credit appraisals carefully and the price of money is low, it's a deadly cocktail. And that has created this enormous problem for the banking sector. So the MPCs therefore decided that if the growth is starting to pick up, if investors are asking questions about capacity, they are going to create new things, then we might as well be telling them that, look, the cost of money is not going to be cheap. You better do your homework before you come to the bank, because the credit in bank has started to pick up. So this is the right time to ensure that price of money does not stay cheap. That has been so it has actually worked. I mean, they've ensured this part of it also by giving industry a warning that you will not get money to finance your projects on the basis of soft money which was available so far. It would have been difficult.
Right.
So I would not say that they would be stopping if they feel that the growth is running on sort of borrowed time, that there's a problem coming up. Then they might even raise the rates even within this fiscal, if they feel that that's necessary to ensure that there's a balance in the banking system.
All right. Closing comments now from both my guests, starting with you, Mr. Dua. The MPC came into being only in 2016. Has it made any difference in the way the RBI looks at the monetary policy?
I think, as you know, the MPC is a consequence of their agreement signed between the government and the RBI. And as Subhomoy mentioned now, it's been made very clear to it, whether because of the insistence of the RBI or RBI's conduct in the past, that you are to worry about inflation, monetary policy as an instrument of management, the government management. To that extent, I think the need to consult the government has become much less. In the past, what used to be said, I don't know how far it's true, that the RBI governors would consult the government before taking a call. Now it's an independent body in which the members have been selected through a particular process laid down in the law. RBI governor is the chairman, but all the members are not necessarily selected by him.
Right.
So there is an independent group which is looking at it, and their actions, what each one said, you can also see it. It's on the website of the RBI. Everybody's
right.
saying. The voting pattern is given. Mr. Dholakia invariably opposing the other five, or taking a stance different from others. The RBI nominees as well as the independent nominees, the other than Mr. Dholakia, taking a particular stance. I would say there's greater focus now with the MPC on management of inflation, greater transparency on what each one is saying, and probably much greater independence in rate fixing than there was before.
All right. Subhomoy, close the show for us with your concluding remark.
Yeah, I would broadly agree that the MPC has, now there are 7 people who get access to the data, and it's definitely better. And you would notice that the RBI governor does not make that customary visit to the finance ministry before every rate hike action. So it definitely does show that things have changed. It does, of course, make the current rate hikes make it costlier for the people who have depend on interest rates. Life changes for them. It definitely would tend to be costlier. But at the same time, if the economy does better, then the flip side of it is that they would get a better income. So that could balance.
All right. On that note, then, we'll slip into a short break now. On the other side, of course, we'll talk about another subject. We'll talk about the draft e-commerce policy. Thank you to Subhomoy, of course, for joining me on the program. Ajay Dua continues with us on the next segment as well. Time for a short break now.
Tales that inspire. Stories of social change. A salute to diversity. Promoting public discourse. Events that motivate. inspiring the innovative spirit. Watch Rajya Sabha television documentaries.
Welcome back. You're watching Policy Watch with me, Rausan Pereira. If discounts and offers give you the thrill, then you may not like the fact that the government is considering to stop the practice of deep discounting, which is a common practice to lure consumers on e-commerce websites such as Amazon and Flipkart. The various food aggregators such as Zomato and Swiggy also offer deep discounts to hook customers onto their websites. It has come as a suggestion in an initial draft policy that was discussed at the meeting of a high-level think tank on Monday. Apart from discounts, all e-commerce companies may have to store user data exclusively in India, given security and privacy concerns. The draft recommendations were prepared in consultation with the private sector and government officials from different departments such as commerce, industry, IT and electronics. These suggestions were discussed by the think tank headed by Commerce Minister Suresh Prabhu at the meeting held in New Delhi. The final draft national policy framework for e-commerce sector based on these recommendations is now in the public domain for further comments. In our next segment of Policy Watch, we will analyze the draft e-commerce policy. Still with me on the program is Ajay, former Secretary, Ministry of Commerce and Industry, and joining us now is Sidhartha, economic journalist. Thank you to Sidhartha and Ajay for being here with me on the program. Mr. Dua, let's talk about the e-commerce policy now, the draft one, of course, and what are your thoughts on it?
The way e-commerce is growing in the country, it might still be about 3% of, or maximum 4% of the $700 billion retail industry which we have in the country. It's growing much faster, said to be 4 times the 4x rate of growth of the retail industry per se. And expectations that it would be almost 50% of the entire retail industry by 2030 or so, the way digital literacy is growing in the country and the digitization things happening here. So we needed to do something about it, undoubtedly. The fact of the matter is that the policy is being talked about, though for quite some time. The draft has come at a time when there were concerns also about privacy and data protection. So this policy is also talked about that. Second, there were issues about in making the e-commerce policy as a part of the so-called Make in India campaign, ownership by Indians, because we've recently seen Flipkart being acquired by a particular company in the US, and between, say, Walmart, Flipkart, taken as one entity, plus Amazon, about 70% of the e-commerce trade in India is accounted for by just these two guys. Whether 66% or 70%, that is something in that range. So how do you go forward when the market is growing, when there are concerns about data protection, there are concerns about the Indians being at the receiving end with deep pocket players like Walmart and Amazon in the market? Should we leave it entirely to people who have greater access to capital, who have greater ways and means at their disposal, or could we also make it as an integral part of growing the Indian ownership, growing the Indian control, because we know the growth is inevitable in e-commerce.
Indeed. So how will the policy, Sidhartha, help the e-commerce sector?
Well, if you look at it, there are 2-3 aspects here. One of the issues here is to bring about regulation of the e-commerce sector, make things a little more predictable. Depending on which side of the fence you are on, you would see some benefits accruing to you. But a large part of the policy is devoted to putting in place a regulatory architecture. Whether right or wrong is still being debated. But the idea is to regulate the sector, make it I mean, things like consumer grievance redressal, etc. A new mechanism is being sought in addition, which is probably going to be an online mechanism as opposed or maybe a supplementary to the current system of consumer courts, etc. So that seems to be the broad idea, but there are areas where there are concerns of regulatory overreach. I don't know if you need a regulator specifically for this segment of the business. I mean, there's no regulator for shops that are retailing. So do you need actually a regulator just to regulate e-commerce? These are issues which need to be debated. What is, I think, at the heart of this whole debate is to strike the balance between being pro-consumer and pro-business. So that's something which has to be worked out.
How do you work out, such kind of an issue, Mr. Dua? What needs to be done? How can you balance it out really as far as the business and the consumer is concerned?
One is that balance required, as Sidhartha has pointed out. A second one I would reiterate is the one about Indian ownership of e-commerce, Indians getting a share of the expanding pie, and leaving it entirely to the guys who have deep pockets.
But someone with deep pockets also means deep discounts for the consumer.
This is
at
exactly
the end of the
the
day.
point I was coming to. This particular draft policy, in order to make the Indians who have much less capital access, much less of their own capital and access to cheap capital, in order to protect them, what's been conceived is within 2 years make giving of discounts, particularly deep discounts, which are higher than the normal, not permitted under e-commerce to the people, to largely people like Walmart and Amazon of the kind. Now this is where, while you're trying to protect one bit the Indian player, you are going to be impacting the consumers who are much larger in number, because these people are in a position to give discounts because their overheads are less. They have economies of scale apart from access to capital. But if you say you can't do that, is it to protect your brick and mortar shopkeepers? Is it to protect the nascent e-commerce players which are Indian owned? So that's one issue which will remain.
That's another problem I have, Mr. Dua. You're talking about nascent players. Flipkart is over 15 years old. You're still looking at it as a startup. You're still looking at it as a nascent company. And I mean, how long do you continue to do that?
No, absolutely right. But Flipkart is now probably not a good example. It slipped out of our hands.
Yeah, but
a couple of years earlier, because it was already out of Singapore, the funds owning it, etc. And now it's gone to a e-commerce player who otherwise was a brick and mortar player in India alone. The fact of the matter is I was just highlighting the issues of balancing which need to be addressed. Second, I think nobody denies that data should be kept in India, but the question is, and for security grounds the government should have access, etc. All that's very fine. But the question is, now we're talking about 49% FDI being allowed in inventory-based models of e-commerce, that a person will get into India because the Indian market is large, but control will still remain with India because he will need to have a 51% partner. And to protect them, another clause that the original promoters, you talked about nascent industries, so in that I get reminded, there is a clause that the original shareholders can continue to control their company even if they sell out, because they would have a different kind of voting right.
Right.
That means, just to give an example, that Flipkart might have sold itself, but the new buyers may not necessarily get the control even if they have a 51% control.
Right.
So that's another provision which has been put in this. And finally, I would say that the issue in this entire scheme of things is, are we going to start regulating this sector by having an independent regulator, as some newspaper says? This is because the government can only think of regulation through a regulatory body, so that some colleagues of my ex-colleagues of mine get some jobs in the government post-retirement, etc. That's the kind of a thing being talked about. So
Right.
I would club these in three issues, three separate issues which need to be addressed when the final policy comes. And may I just also add, there is a grievance being expressed by the stakeholders, saying this policy seems to have been more worked out amongst the ministries, bureaucracy, the political masters of the government, rather than consulting the e-commerce players and others who are going to be impacted by it.
Okay. Sidhartha, how do we improve on this draft? And what more needs to be added, do you think, so that it's holistic in nature?
I think the basic problem with the policy is that it's sort of a nanny state policy, where the government is dictating how business should be run. Don't offer discounts. Someone with 5% or 10% can still exercise influence or control beyond his shareholding. Those kind of things. Where it needs to be done, what needs to be done, and there are short-term fixes. Why it doesn't address the problem? Why are people accessing foreign capital? The problem is you don't have Indian Indian companies, investors with the financial muscle to actually support these entities. So that is why, since you cannot do this, you're substituting with foreign capital. Now, what you need to do, which is a larger reform that you need to do, is to develop a market, the capability to have Indian financial institutions, Indian financial investors to support these kind of ventures, which unfortunately we haven't managed to do 25, 26 years after, 27 years after reforms were initiated. So these are more basic issues which need to be addressed. Now, as far as this policy is concerned, it needs a complete overhaul. Whether a company offers discounts or not is a decision that should be left to a company instead of getting a bureau to control prices. What you need to do is to ensure that you're not abusing your market dominance or your market position and offering products which wipe out competition. Now, you can't have a situation where any company, for that matter, XYZ, wield such kind of influence that the other players, like say a Kirana store or one of these retail chains, are forced to shut down by offering below cost prices. Those kind of things need to be addressed instead of reinventing the wheel to create chaos in the market.
All right. With that, I'll have to call it a wrap on this edition of Policy Watch. Sidhartha and Ajay, thank you so much for joining me on the program and putting things into perspective for us. We'd like to hear from you as well. You can share your feedback with us. Our email ID is policywatch.feedback@gmail.com. You can also tweet to us using our Twitter handles at FRP09 and at Rajya Sabha TV. That's it from me. See you again next time.